Hello, happy Wednesday, happy hump day, everybody. Geico Camel Day. How's everybody doing today? Let me know if you can hear and see me okay, please. We are going to do a continuation today of yesterday's calendar spread. Hey there, Steve. How you doing? Appreciate you. Yeah, we're going to do a continuation today of yesterday's calendar spread discussion. How you doing there, everybody? All right, Kevin, David, Justin, Gus. All right, we got it all here. Just as a little precursor to our discussion here, markets are pretty steady. I think things are going to probably pick up volatility-wise within the next 45 minutes or so. Got the Fed decision coming out at 1 o'clock in 1 hour, and then Powell's commentary at 1:30. So before we get going here, if everybody can subscribe, smash the like, would appreciate that. It always helps us out. So if you can do that, thank you. So before we get into the calendar spread, I want to talk about what is on the docket with the Fed today. All right. So I just put these notes together a little bit. I can answer some questions later on about it, but for today, what's the Fed going to do? The expectation right now is 99.9% probability according to the CME FedWatch tool, which I'll bring in here momentarily, that they are not going to do anything. Okay, so here is that right here. So this is 99.9% probability that rates will remain the same. Okay, now if we look ahead to the next meeting, which is at the end of July, still a really, really high probability that they're not going to do anything. 85.5% probability of no cut. But then September is where that really comes in here. September, you can see there is about a 65% probability or so that there would be a cut in September. Now, doesn't matter that they're going to come out and not cut today. What does matter is what Powell says. Is he going to be more dovish? Is he going to say, well, things are still the same. We've got to monitor the situation. We don't know how tariffs are going to affect the economy. So is he under pressure? Absolutely. Even as late as just a couple hours ago, President Trump was berating him, said he would do a much better job than Powell. There's definitely no love lost between the two. But it is more than likely that, they are not going to do anything. Now, one of the issues about the Fed and what they look at is the data they look at is backwards looking. Okay. It's not predicting what may happen in the future. So there is something called a Fed dot plot, and that's where each member of the Fed, literally on a dot plot, like a Rorschach, plots out where they think rates are going to be in 3 months, 6 months, 9 months, all the way out. I believe it goes out 3 years. Okay, and I believe they are going to show that today. They don't show that at every Fed meeting. I think they show the dot plot at 6 of the 8, if I'm not mistaken, but they will show that today. So we'll see what Powell has to say. We'll see if there's a market shift in probabilities of potential rate cuts. But for now, we're going to go over to a continuation from yesterday. But now we're going to talk about calendar plays, time spreads, if it is specific to earnings. Yesterday, we talked about calendar spreads when vol is low, and what a great, great opportunity time spreads are, whether it's calendar or whether it is a diagonal, to do that when volatility is low, because we are definitely trying to buy time when it is cheap. Okay, so just as a quick review, we went through this yesterday. Calendar spread, Okay, same strike, different expirations. We only trade them from the long side, meaning that we buy the one further out because of margin issues. Shorting those, they can be a great opportunity at times, but because of the margin required to short a time spread, we don't trade those. Okay. Any questions on what a calendar spread is before we dive into the earnings side of things? Is everybody pretty comfortable with the concept of a calendar spread? Okay, looks like we are good there. All right, so I've got a chart here, and this is a chart of a signal we put out earlier this morning. Okay, this is ACN. Okay, here's a 1-year stock chart. Those of you that listened in, I was on Schwab Network earlier this morning talking exactly about ACN. You can see this consolidation right here. Okay. Yes, in the big market downturn, this thing did get hit like many other stocks. But if we go back, we can see that same area right here was resistance, then it was support. So I'm looking at this consolidation area here as perhaps the precursor to a move up. Okay. Now, volatility is not cheap. So yesterday we looked at volatility when it was really cheap. Here is also a 1-year look at the implied volatility in ACN. And we can see, although it's not at the tip top, this tip top here was when the stock really took a dive, when the market took a dive, a couple months ago. But vol is still pretty expensive. So we would look at this and say, boy, I don't want to buy that volatility. Right? Does that make sense? Can it be done on the SPX with 0 DTEs? It's much harder to look at volatility on 0 DTEs. Just like if we have a regular option and we get to, expiration, the Friday of expiration, you can't really measure implied volatility. There is a value to it, but it's really, really difficult to measure that. Now, you definitely can look at 0 DTEs as maybe a hedge against buying something else. So selling one that expires today, buying one that expires Friday or next week. You can definitely do that. Okay. So does everybody see that vol is pretty high, as it should be going into earnings for ACN here? Everybody see that okay? Okay, great. So how do you play that? How do you still get a fairly inexpensive type of strategy and play that? Well, first thing I'm going to do, I'm still going to go through the computation of what is the expected move, what is the market pricing in. Volatility is higher, so it's going to be pricing in a greater move than if volatility were back down where it normally trades. So if we look at ACN here, stock at the time was 310.85. It's 310 right now. But if we look at the expected move here, we really see somewhere between 18 and 19 bucks. Okay, does everybody see that? Okay, great. So if I'm looking at the upside here, I'm really going to be targeting somewhere around 330 based on where the stock was trading. Does everybody see that? Okay. So we've got that. That's still always the first thing we're going to look at, or the second thing if we look at vol first. So what I did for earnings, I usually look a little bit differently. For earnings, I like to select strikes that are just beyond the expected move, 3-5% beyond the expected move. Okay, so what I'm looking at in ACN is to sell this week's 345 strike. Okay, so that's what I looked at, which is about 4% or so off of greater than where the expected move is. Now, we know that this current implied volatility for this week is not sustainable. It's not going to stay there, right? We see a 95, 100% implied vol. We know that is not going to happen, which is why looking at this implied vol chart is so incredibly important. Okay, because we know there will be 100% there will be a vol crush after earnings, regardless of what those earnings are. Good, bad, and different, regardless of what the stock does, there is going to be a vol crush. Okay, so we need to know, we need to feel comfortable, okay, how much that crush is going to be. Okay, now you will not find this anywhere on YouTube, the internet. This is my calculation based on literally 30 plus years of doing this and understanding what really happens to volatility after earnings. Okay, so the near term expiration, which gets hit the hardest, reacts the most from earnings, that would be this Friday, June 20th. Typically, we will see that implied vol drop by half, by about 50%. Okay, so what you will see right here is I adjusted to get a post earnings value of that option. I adjusted that down to a 55% implied vol. Not quite 50% of the 95 it was at, a little bit shy of that. Okay, 50. That's right, Kevin, 50. Okay, but I adjusted this down to a 55%. Now, it is just as important, and probably more so, to be able to adjust the long option, the one that we are buying. Okay, and be somewhat accurate with that. So what I did here, and what you'll notice, guys, is rather than a calendar, I actually just put out here the exact signal that we sent this morning, which was actually a diagonal instead of a calendar, but it is the same exact properties other than the strike is different. Okay, so in our signal this morning, and what I'm evaluating right now is selling this week's 345, buying next week's 340. Okay, so rather than just having a similar delta on each, this, by doing a diagonal, as we spoke a little bit about that yesterday, allows us to have more directional or delta bias. Does everybody understand that? In terms of what vol is going to do, it's going to have the exact same effect. Okay, does everybody understand that? Okay, great. So what you will see here is that I reduce the implied vol for the option we are buying by almost 50%. What typically happens is the first week out, not the week of earnings, but the next week out, you will typically see vol drop by about 40 to 45%. So drop by 50% in the current week, 40 to 45% next week, and then slightly lower each subsequent week moving out. So what I did is I dropped this nearly 50%. Okay, because I want to, in my calculations and in my risk profile, I would rather overshoot, meaning I would rather underestimate the vol for our long option, overestimate the vol for our short option. And then if the risk profile still looks good with those adjusted volatilities, that's really what I look at. So does everybody understand this adjustment here? Excellent. Okay, so what I'm going to do right now is I just brought in here the live trade ticket, order ticket for what we're trying to do on our spread. And we are $1 bid on this. Okay, we are $1 bid on this spread. It traded just a couple contracts. I think one person got 2 contracts filled. But if you look to see what the market is, okay, the market right now is 80-cent bid, offered at $1.65. Okay, does everyone see that? Thank you, Aladdin. Does everybody see that? 80 bid offered at 165. So, you would think that the midpoint there would be somewhere around $1.20, just rounding off. Okay. But how come on our calculations, we're showing a value of literally only 8 cents? How come? Right. That is because of the expected crush. So if we were playing this for today, there's no way I would want to pay $1 for this when I have it valued at 8 cents. Okay. So why would this potentially be good? Well, if you plug this into your Thinkorswim, whatever model you're using, whatever brokerage or platform you're using, okay, this is what the P&L graph would look like on Friday. Now, it's key that we use Friday's date because earnings are Friday morning. So this is reflective of what the implied volatility might be. Actually, excuse me. This chart right here shows what the P&L would be with no adjustment in implied volatility. So if you just plug this into Thinkorswim or whatever platform you're using and didn't use any adjustments, you're going to see a P&L something like that. Okay, and take a close look down here. Take a close look down here. Everybody see that? Okay, so let's just pinpoint something here. Let's say at 354, this is showing a $6.60 profit per spread. Okay? Does everybody see that? Okay, now what we have to do though is run a risk P&L, a risk profile with the adjusted implied volatility. And before we review that, let's get Thor out here today. Thor is saying the word of the day is adjust. Make sure we adjust those implied vols. Everybody get that up there so we can get you on the wheel today. Give that another minute or so. All right, let's go back to the P&L graph with the adjusted implied volatility. Thank you, Aladdin. Okay, so what you will see here is the P&L, though still really good, is not anywhere close to what the P&L was if you just looked at it without an adjustment and implied volatility. I think if I go back a slide here, when we were looking at 354 on the non-adjusted vol, we saw a gain of about $6.60. Outstanding. But if we do the same evaluation with the adjustment, it is significantly less. Still good. Still good. Don't get me wrong. But significantly less. So it is imperative, absolutely imperative, that you understand how the vol crush will work, how much of a vol crush there will be. Okay, so again, first expiration, figure about a 50% crush. Next, 40 to 45%. And then each subsequent expiration from there, just down a little bit more, a little bit more, or excuse me, a little bit less, a little bit less, a little bit less. So let's go through something live right now. Okay, I did ACN, which we have a signal out there for. I'm going to look for another stock. Actually, here's Micron. Okay, I'm going to use Micron just because they have earnings next week on the 25th. Okay, so here is stock chart for Micron. I am not using this as a signal, guys. I'm not using this as a call right now. I'm just doing this as an example. Okay, let's say we wanted to be bearish Micron for whatever reason. Okay, again, this is just for an example. Let's say we want to be bearish. Okay, well, first thing I want to look at is where is implied vol? And implied vol right now is actually not that expensive. There, no question, it will pick up into earnings next week. It will pick up. There is no question about it. Okay, let's see now what next week's implied vol is actually trading at. You get these guys. Oh man, I am just butchering these watch lists here. Okay, so if we go to the 27th, stock is trading 122. Okay, we can see that vol is already up. It's about 80%. Okay, it's about 80%. We just saw that chart right there that said it's trading at about 54, 55. So if we were to look at right now what the expected move is, we're somewhere between 12 and $12.50. Okay, does that make sense to everybody? How to choose shorting puts. You mean selling put? Okay. Okay, so again, example only. If we were bearish with an expected move of 12, 12 and a half, our target's going to be around 110. Okay, does everybody agree with that? So what I'm going to look to do then, let's say we wanted to do a calendar, I'm going to go to the 110. And what would you adjust? What would everyone here adjust that implied volatility to? Knowing that earnings are next week and this is the first expiration that will encompass those earnings. What kind of adjustment would you make? Okay. Good. Good, you guys. So typically, again, I'm looking at 50% adjustment. But as I said before, I want to be conservative. So maybe instead of lowering this to 40, okay, maybe I only lower it to 50. Okay, so I'm going to put this in here now as a 50 implied vol. Okay, now let's say we want to just go out 1 week. Okay, calendar spread for 1 week, and we go out to the July 3rd, 110. Okay, what do you think we should adjust that implied vol to? Anybody? Okay, I like that. Anybody else? Okay, 30 I would think would be way too cheap. 30, we're cutting well over 50%, probably more like 60%. And what I want to do, remember, is let's go look back at the implied volatility chart in Micron. Hang on, here it is right here. Where do you think the low point that this may settle in at is? I'm thinking, kind of right in here. 42 to, 45 area. Right? So again, I want to be conservative in my guesstimates. So I'm going to go lower. I'm going to go on the low end of that, and I'm going to adjust my vol to 42. Okay? So that's what I would do. I would make that, somewhere. We're never going to be exact, but we need to be really close in the ballpark. So with those adjustments, this spread probably would cost us 38, 39 cents or so. But you can see with the adjustments, our theoretical value midpoint is only 13 cents. Okay, let's look at what a risk P&L would be on this. And the way we want to measure is not today, not tomorrow, but we want to look at this post earnings. So we're going to push the day ahead to the 26th. Okay, and what I see here, if we're right and we get that stock on the downside here, That's what I'm looking at right there. Okay, does everybody get that? So I think, what did I say? This cost us 39 cents. So if we get right to the strike, we're looking right at that 2-to-1 reward to risk we talked about yesterday. I want to put up one more thing here. Now, look at the difference between what we just put out there and what the risk P&L looks like if we didn't make an adjustment. Look at how unbelievable this looks. Way different from the adjustment. So if you were just to plug this into your platform and make no vol adjustments and run a P&L for next week on the 26th, this is what it's going to look like, but that's not real. That's not real. It is way overstated. That's why it is so imperative to understand the vol crush, how much vol crush there is, and how we can hopefully play off of that. Okay, everybody? I don't expect everybody to completely understand diagonals, calendars right away. It is definitely a concept to learn. But understanding when there might be a vol crush is imperative. Okay, wheel is closed. Let's bring in the wheel today. A little bit more crowded than it was yesterday. Let's give it a Jerome Powell Fed spin, since he'll probably be spinning his comments later. All right, David Roberts or Francisco, who is it going to be? David Roberts, are you in the house? David Roberts, are you in the house? Yes, wonderful. All right, you know what to do, right? Shoot me an email. Shoot me an email at prosperswag@prospertrading.com. All right, everybody. Could have some fireworks this afternoon. Everybody be ready for Powell and the Fed comments. And don't forget, we have an off day tomorrow. So I will not be here tomorrow. David, nice one. Good one. I like that. All right, everybody. Appreciate all of you. We'll see what we have this afternoon. Might be some opportunities there. We will see, but appreciate all of you and see you back on Friday.